All right, guys, here we go. Ready to get started for another Lunch and Learn presentation. As always, these presentations are for information and for educational purposes only. So if you're viewing this on our YouTube channel or on Twitter or Facebook, when you're taking this information in, just know that you shouldn't be using it for investment decisions. You can look up the full terms of use and legal restrictions on our website here, and also provided in the video description. But we put these videos together for you guys because we know not everybody can make it to each of our lunch and learns. We do these on a monthly basis, and today's topic is one that I'm passionate about, as far as, are all market environments the same? And if all market environments are not the same, should we be driving the vehicle the same way? When we invited people to this presentation, we talked about Highway 50 that crosses the United States. It covers 3 different mountain ranges in the Great Plains, and in each of those environments you're not going to drive the same. And the same thing with market environments, not all of them are the same. And a lot of places will say, modern portfolio theory says you should own everything to be diversified across everything and buy and hold, which I say is the equivalent of basically driving 70 miles per hour regardless of your terrain. I don't think that's the correct assessment. We think there are different markets, and we use the Adaptiv System to identify those different markets and how we should be driving our vehicle during those different market environments. These are part of our Lunch and Learn series that we do. Just remember that they're every month on the 3rd Wednesday. We put them on. This one happens to be on markets. I do these quarterly. For those who don't know me, this is my poorly taken selfie, but this is me right here. My name is David Zarling. I'm head of investment research at Client First Tax and Wealth Advisors. I put these presentations on a quarterly basis. We also have additional education we do every month. You can find it via this link here. They are free, so we invite you to come. We get a good crowd. We eat some good food. I'm even wearing this crazy hat here, Fiduciary hat, and we'll get into that in a little bit here. But this is an event you can come to, enjoy some food, get to know us, and go through some important topics. You can find maybe a topic that you're interested in by going to this website here, clientfirsttaxandwealth.com, financial education. So check it out. Before I get too far, though, I do want to congratulate our tax team. As you know, we are a fiduciary. We're trying to work in the best interest of our clients, and part of that is understanding our clients' tax picture. So we do tax planning and tax preparation for our clients. These lovely ladies here worked really hard over this past year. Renee, Meredith, Stacy, and Greta put a lot of work in. We did preparation for over 500 tax returns. They did a great job, a lot of long hours, but before I get going too far, I just wanted to congratulate them. They should be recognized for doing such a great job for our clients. And as you know, when I gave this presentation live, there was another batch of snow on the ground and falling at the time of both presentations. We did a lunchtime and an evening one, and it was April 18th. It's snowing, extremely unusual, but that's the nature of the weather environment in Wisconsin. And we know that baseball and winter aren't really a great mix. The day after that presentation, we were supposed to have a baseball game, but couldn't because there's snow on the ground. And some of you might know that I moonlight as a coach. I coach some of my kids' teams, whether it's baseball, soccer, basketball. But it's hard to practice outside, and it's hard to play baseball outside when it's winter, so it's not too good of a mix. However, when we do these lunch and learns, I tell you what, it's a great time because there's nothing better than having some good food and talking markets. That's just something that we're passionate about. We think lunch and learns are a very good thing because they keep our friends off the streets. So I highly encourage you, if you ever get a chance, come check us out. We have a good time. We dig into markets, which is the 8th wonder of the world, and we just enjoy that time together, and I think highly of it. Our agenda for today, we're going to cover a multitude of topics. We're going to talk about, is the bull market over? We're going to talk about, will tariffs cause a trade war? Both of these are topics that seem to be in the news a lot. And with the recent correction, that we've had since the end of January, January was the best stock market month since 1955. But yet when you take the 3-month period of January through March, the first quarter, it was the worst first quarter for the stock market since the Great Depression. So is there something more going on here? Is it because of tariffs? Is it going to be a disaster? Is it going to provide some opportunity? We'll dig into that. We'll also talk about that fiduciary hat, that picture I showed you of my poorly taken selfie with that hat. What's the deal? Why was I wearing that? And we'll get into what it means to be a fiduciary, because that's a very important distinction that we want to make people aware of. And then how do we adapt to different markets? So when we talk about, is your retirement vehicle adaptive, we're going to dig into how does the Adaptiv system help our clients navigate different market environments. Then what we usually do for each of these presentations is go through some Q&A. Obviously, we can't do that with a recorded video, but I encourage you to reach out to us if you do have questions about our Adaptiv system or any of the different solutions we provide for our clients, whether it's our tax planning, tax preparation, our financial bucket planning, our property and casualty insurance line, our endowments and foundations, any of those different topics or things, or estate planning, feel free to reach out to us. I'll provide a website and phone number in the description. Feel free to give us a call. That's why we're here. So let's dig in. Big question here as we're heading into May. I'm actually recording this on May the 4th, so May the 4th be with you. But the big topic is the bull market over? We've had a great run since late 2016 through, the end of January was a very large move in markets, even though maybe the media didn't necessarily pick up on that during that time. But it's a worthwhile topic because we know trees don't grow to the moon. And we've had market corrections in the past, and this is where, you need to have some history with me and have attended our last lunch and learn regarding markets, and we were looking at some indicators. Maybe you watched our last video on markets, and there's some indicators we can look at. If you remember the dot-com bust from 2001, another market correction in 2008, 2009. What about 2018? I mean, we've had a quick move down in price here in 2018. Could anything have foreseen this? And if you remember, I in my last presentation, I kind of highlighted some really important events. So in 2000, you might remember the Vikings lost in the NFC Championship game, right? In that 08-09 season, Brett Favre on the Vikings, they lose in the NFC Championship game. And so, in my last presentation in January, the Vikings were heading into the NFC Championship game, and I was telling people, man, we should really cheer on the Vikings because you don't know what's going to happen with the market if the Vikings lose the NFC Championship game. Well, I believe it was January 21st or 24th. I don't have the exact date. It was over the weekend, obviously, but that's when the Vikings lost to the Eagles in the NFC Championship game, and of course the market sold off because of that. Now, obviously, I'm joking, but we had some fun with it. I had some clients stop in the office wearing Eagles shirts just to give me a hard time. If you haven't figured it out by now, I'm a Viking fan, so don't hold that sin against me. Jesus died for that too. So, getting a little bit more serious, when we talk about this move here, we had a nice run. Here's the election. We had a nice run all the way up through the end of January, and then this very sharp move down. What's going on here? And as consumers of information and trying to discern what market environment we're in and how our retirement vehicles should operate, many times we turn to news, right? We turn to We want to find information somewhere. So where do we turn? A lot of times we turn on the TV or go online. And I will contend that that is not the best place to go. In a minute, we'll talk about what it means to be a fiduciary. That means we have to operate in our client's best interest. And my argument to you would be that the media does not have our best interest in mind. Remember, they have advertising to sell. They need clicks on their websites. They need views on their TV screens. And they're not always right. Sometimes when we consume information on a day-to-day basis, we fail to recognize fact from opinion, and we fail to recognize whether the fact or opinion provided on that day later turned out to be accurate. We may consume news today, and then 3 months from now, that news that we consume, we don't look back and say, was the media accurate? An example of this, going back to the 2016 election, everybody in the media had Hillary Clinton winning the presidency. And again, I don't want to get into a political thing. This is really highlighting the information we consume. How accurate is it? And back then, everybody was basically saying, Hillary's going to win the presidential election. We don't really have, political opinions here. We don't manage money based on political opinions. We base it based on price, which is fact. And we used price. You can look on our Facebook page leading up to the election. We actually believe there was a high likelihood that Donald Trump could be elected president, not because we wanted him to or didn't want him to, but just based on market data that goes back quite a ways. There was a strong possibility that Trump could win the election, which was very different than what the media was portraying at the time. Kind of going down that line of thinking, if you remember, going back, sometimes we forget the screaming, I guess is too strong of a word, but the gnashing of teeth at the idea of a President Trump. And if you remember, people were saying, the stock market's going to crash. On election night, people were freaking out. We have people like Mark Cuban saying, there's going to be huge, huge losses. And we have someone from the New York Times saying, if Trump wins, the markets will never recover. So this was the major narrative at that time. And even with this correction that we just had in January, in February, if you hadn't participated in that, you've missed out on a move that was 25%. And that's kind of a big deal, that if the media influenced investment behavior, that's a problem. Maybe they don't have investors' best interest in mind. Even when we look at experts, right? Each year in January, it's where major world leaders come together. It's, economists, prime ministers, royalty, presidents, economic advisors. I mean, it is supposed to be one of the biggest think tank events of the year, and it's a big deal. They've got security there up the hilt. They've got major speakers and major panels, and
experts also have an opinion that tends to get communicated through media. And I like to highlight that sometimes elite government officials or economists, if we are in the business of trying to get people to predict things, that becomes very hard. And to be, prudent in your investment strategy or system, we don't need to predict. But as consumers, for whatever reason, we love to see who's going to predict what's going to happen. And the elite do the same thing. And so at this Davos meeting in 2016, here they are alarmed at the prospect of Donald Trump, who was a nominee at the time. And you'll notice that from there until the January meeting, where Davos elite all of a sudden changed their opinion that Trump is good for business. So they went from alarmed to Trump is good. Well, what changed? Well, I think we all can see from this chart what changed.
price change. So this is the price of the S&P 500. If you're not familiar with that, it's very similar to the Dow Jones. It's highly correlated to that. It's different in the fact that it stands for Standard & Poor's 500. And the way to think about it is when you go to a grocery store and you fill up a cart, you've got milk, steak, eggs, you got to have some vegetables in there and some fruit. Each of those items have a different price, but when you go to the checkout checkout counter, it's one price. That's S&P 500. You've got 500 stocks. Yes, they all have their individual price, but the S&P 500 tallies it up and it's one price. And so this is the price of that basket of stocks from when DeVos was alarmed at Trump to when they thought he was good for business, and the thing that changed was price. So my argument and thing that or main piece that I want you to take out of this is news does not dictate price. Okay, many times we think when we're consuming news such as tariffs or those types of things that affects price. It may on a day-to-day basis, but really these major moves, price happens first and then the narrative changes or the opinions change. So the difference between this opinion and this opinion was price. Obviously price moved first. And I don't know if you've ever heard of the phrase wet streets cause rain. Well, we know that that's not true. So news doesn't cause price movement. It's the other way around. Rain causes the wet streets. Same way, price is what dictates what's coming through in the news. So when there's some type of move in the market that day, there's no possible way for CNBC or Yahoo Finance or whoever you consume your financial news from to know exactly why that move happened. But yet, they will come across as if they know what that move is about. Oh, there's been a huge inventory build of crude and that's why the price is dropping. Or we've got tariffs going on and that's why the price is dropping. So they come across as experts when in fact what they're doing is attaching a reason to an event that already took place, which is completely useless and non-actionable for us consumers of that information in order to try to invest. And when you combine that with experts and put them on the news, it's a bad combination. These two guys manage a lot of money between them. Ray Dalio, one of the biggest hedge fund managers out there. Stockman, also a very large money manager. We've got these experts back in November 2016 here telling us to sell everything. And then another expert here telling us in January, if you're holding cash, you're going to feel stupid. Well, that's terrible information. If you had actually acted on that information just based on their opinions, how good would that have been for your portfolio? And so we need to understand that maybe we should be using the underlying data. Maybe we should be looking at the rain itself rather than the wet street. We should be looking at price rather than the news to make our investment decisions. And it's always late, when by the time the rain's already fallen, well, the street's obviously going to be wet. And so when we see news covering certain topics, it changes based on what price does. To prove this point, here towards a high, the street is telling us stock market bears are the dumbest thing on Wall Street. A bear, what that means is a stock market bear is someone who believes that the market's going to go down. And so they're calling those type of people dumb right at the top. If you think about that, it's almost laughable. And then you have a price move, okay? You have a price move down, and now all of a sudden we're talking about certain economic advisors retiring. We're talking about the Fed chairman. We're talking about NAFTA. We're talking about tariffs at these price lows, right? These are when these news story comes out, when there's fear. Oh man, what is going on? What's the big deal? Then the stories come out. And here's the deal. By the time it's news, it's too late, right? Like I just love this sign, like, hey, this way to the secret bunker, well, then it's no longer a secret. By the time it's in the news, by the time you're consuming that news, it's too late. Price moves first, then the news reports on it. Here we have an example of this during these lows. We've got someone claiming that there's a 40% plunge in stocks ahead. Well, is that being reported here because this is a fearful moment in time? Because there could be a 40% plunge in stocks ahead, but the idea that anybody knows when that is pretty tough to consume. And so we just need to understand what news really is, right? It's entertainment, and it's often useless. You know, these actual real life article here that China might be hiding their submarines in the water makes me laugh. And sometimes it's not that obvious though, but we do have to make sure that we're forming our own opinions using the facts that matter. Sometimes we form opinions based on the opinions of others and their opinions are based on facts that don't matter. And so we need to make sure that we're understanding how we're consuming information and whether that's good or not, or in the best interest of our portfolio. So one of the biggest topics lately has been trade wars based on tariffs. If you're not familiar with the tariff, they've been around for a long time. I'm really not here to talk about whether they're a good thing or a bad thing, whether they should be done or shouldn't be done. I'm about as free market as they come. So I'm probably not a fan of tariffs, but we should cover this topic because it's been in the news a lot lately. And the way to think about it is a tax on a good or something that's being imported into a country. And I've got an example here that kind of give you an idea. You know, when we talk about tax, we think about maybe it's an income tax, so we get a paycheck, but part of that paycheck's given to the government as a tax, or maybe we go to the store and we buy something and we also pay a sales tax. The way taxes work, tariffs work as a tax are really between countries. So in this example here, this is between Australia and Japan. And in this example, we'll make this pretty simple. You know, in Australia, they can make cars for about $12,000 to $13,000, and that's what they're buying them for. Well, over in Japan, they can actually make a car for less. You know, almost, you know, maybe $1,000 less. They could sell them in Australia, and maybe the Australian government doesn't like that because they want to, quote unquote, protect their workers. And so they will add a tax to increase the price of this car up to, you know, something that's more competitive with what they're producing inside their country. Again, you can agree whether that's good or bad. That's not what I'm really here to point out. I'm here to just educate on what a tariff is. And this is a really good example. You know, Australia is adding on a cost to a Japanese car to make it competitive to an Australian car. Because if you think about it, you know, maybe Australia is thinking that if we just let Japan bring these cars in here and they start selling for $11,500, well, no Australian's going to want to buy, you know, the more expensive Australian car that's made by Australian workers, and then everybody will be out of work. That may or may not be how that actually works, but that's their thinking. And really, like I said, tariffs have been going on. They exist. It's not some new story. You know, China has an average tariff rate of 3.5%. So anything coming into China, they add a tax on average of 3.5. So it's an average. It could be, you know, 0.1%, and it could be 17%. Russia has a tariff. Brazil has an 8% tariff. I have no idea what's in Gabon that requires such a high tariff. The United States even has tariffs. They've had tariffs for a while. And so there's these different countries have different average tariff rates. And when we look at what's the news, right? The story is about tariffs with China. So why China? Why is China the one that we're having this tariff or trade war dispute with? And quite simply, it has to do with we consume an incredible amount of Chinese goods. And the way to read this chart from Statista charts is basically this is our trade balance. So trade balance means what's the difference between what we consume from another country or import versus what we send to that other country to be consumed or export. Okay, so we have things that we make in the United States and we send it over to China and they buy it. China has stuff that they make and they send it over to us and we buy it. In that relationship, if we just look at it, we consume way more of Chinese goods than they consume of ours. Another way to look at it is basically is what's called a trade deficit, right? We import almost $500 billion worth of goods from China, while China only imports about what is that, a fifth or a fourth of that from us. So there's this huge imbalance that's been going on forever. So this is the amount that we import from China in blue, and this is the amount that we export to China in red. And as you can see, there's quite a big spread there, a big change, a big difference. And so that's why China might make a natural partner for tariffs. Meaning, when we look at that relationship, how much are we sending to the European Union and how much are we importing from the European Union? How much are we sending to Canada and how much are they buying from us? When you look at these relationships, Canada, Mexico, Brazil, Switzerland, even the EU, they're mostly balanced, okay? But however, when we look at the relationship with China, it's way out of balance. And so that's why these tariffs and trade talks are that's why China would be a target for tariffs. And so when we look at trade and we identify what are the things that we import from China and what are the things they consume from us, so the things that are in the news about tariffs really involve, aluminum and steel. So, we're going to go ahead and put a tax on anything that comes over from China. So fabricated metals, we import a lot of fabricated metals, a lot of steel and aluminum. We export a lot of farm crops, and so then China's retaliating and saying, hey, we're then gonna tax farm crops. So that's why this is happening, is we consume a lot of their metal goods, they consume a lot of our farm crops, and these are the things each country are looking to tax, and that's why some people would use the term trade war. And then media will say, well, okay, if they're going to put a tax on these things, you'll notice that these are the jobs that will be affected, fruit and nut farming, canning, wineries, things that are agriculture. And then we're also talking about there's a lot of aircraft manufacturing parts, those types of things. And that's what the news is pointing out. Hey, these American jobs could be hurt if these raw materials, these agriculture commodities are taxed. These airline parts or airplane parts are taxed. That's really going to affect the American worker. At least that's the theory. And so these news items about tariffs really started showing up at these levels where price had corrected quite a bit. And again, remember, the news is sitting there going, well, why is this happening? Right? Because it doesn't sound sexy to say, well, price is dropping because of economic law. There's more supply than demand, right? Because more demand for something than supply causes price to rise. So more demand than supply, price rises. More supply than demand, price drops. But that's not good enough, right? Like if someone asks you what happened in the market and you're like, well, there was more selling than buying today, that people don't like that. And so it's a catch-22 because the consumers want something different, and the providers of that information are willing to provide alternative reasons rather than just economic law. So when these news stories came out, they were actually after price moved, right? Remember, price first, news second. And so here we have these news items on tariffs. Well, what we don't realize is this has been going on for a while price has been rising. We've had, right away, the U.S., we withdrew from the Trans-Pacific Partnership. That was a trade pact between the United States and some Pacific Rim or Asian countries. We withdrew from that. We started renegotiating the North American Free Trade Agreement, which involves Canada and Mexico. We began renegotiating that. We even started talking about, in summer, tariffs, so trade agreements between the U.S. and China. And that's the other thing that can be kind of confusing about tariffs when people talk about them, is they'll say, oh, tariffs, and it's automatic assumption that that means it's going up. So it'd be very similar to me, there was a new tax law that came through in 2017, and it'd be like saying for that, oh, there's going to be a new tax, okay? But really, in the end, it was a new tax plan, right? And out of that tax plan, actually, there was a lot of tax cuts that happened. So when the media communicates tariffs, they'll say, oh, there's new tariffs, which would be a lot like saying, oh, there's new taxes, which isn't actually accurate. When we say there's new tariffs, that could actually mean a reduction in tariffs. And so when we're looking at this, price is rising all through these, the US announced tariffs on washing machines and solar panels. China also announced new tariffs. Again, this is how the media portrays it, new tariffs, but we'll get to there in a second. But so the idea that tariffs all of a sudden matter here, but didn't matter during this price rise here, is a little bit disingenuous by the media. And so we need to identify, for example, going back to pointing out, okay, China announces new tariffs here. What does that mean? It could sound terrible. Oh, they're taxing more. Not necessarily. When they did that in November, they actually reduced their average tariff for US type goods down to 8%. Okay, so they applied to 187 different product types. There's some listed here, but it's that new tariff plan from the United States actually was reducing the amount of tax on goods coming into China, which is a good thing for trade. And so here we have the media latching on to something after price has moved already, even though these things were in play while price was rising. So what's really going on here? Here we get Trump threatens China right here with another 100 billion tariff plan. Okay, so that sounds just completely terrible that there would be a 100 billion tariff plan, and the market's already corrected, things look really bad. What's going on here? Well, if you look at the difference between China's importing versus what we import, basically we had initial tariffs on goods coming from China, and then there were additional tariffs that were being talked about, and then the latest proposal that hit the news was, hey, we're going to increase, so basically think about it as a tax base, that $100 billion worth of goods that comes in from China, so 1/4 of the total overall that we consume from China, we're going to have a tax on that. Well, what's interesting is that by announcing that, China couldn't match, because this graph here shows what they import from us. So remember, it's not even close to what we import from them, and they can't even possibly match the latest US proposal. And this got people very nervous, and they started talking about China not buying treasuries anymore, which people thought that was a very big deal, because if you remember, when bond prices rise, okay, if they're being bought and causing demand, yields drop, okay, which many people view as a good thing. If China were to slow or stop purchasing US treasuries, well, that would cause bond prices to fall, which means interest rates would rise, so yields would rise. So that means things like mortgages could potentially go up in cost, or loans that people take out. And so really that was a huge fear. But if we walk down the line of what really happened, that's a fear that arose around January 10th. April 5th is when Trump threatened the new $100 billion tariff plan. April 10th, which is kind of interesting, after this proposal was made, where we were basically saying, yeah, we're going to tax all the goods coming in from China. It was interesting to note that within 5 days, President Xi of China announced plans to open China and lowering tariffs on imported autos. They had very large tariffs on American autos, and they were going to reduce those. And April 17th, not only did China not slow, halt, or sell their treasuries, they had the largest ramp up of holdings of U.S. treasuries in about over half a year. So they actually increased buying. So people were very fearful of this, according to the news, but in actuality, what China ended up doing is opening up their economy more and buying more U.S. treasuries. And so if you remember, it was tax reform. Okay, and everybody thought the market was going up because of tax reform, and we wanted to highlight something different. These are the charts of major economic stock exchanges, or major stock exchanges across the world, and notice how they're all going from lower left to upper right. Okay, so if there's U.S. tax reform driving prices up, why is the whole globe going up then? Why are all the markets in the world going lower left to upper right? And now we've
got the lowest number of countries in recession ever. Well, that probably doesn't have to do with U.S. tax reform. There's probably something bigger going on. And I don't know if you remember this. This goes back to my October presentation, Lunch and Learn presentation on markets, where we talked about, remember at that time, oh my goodness, what's North Korea going to do? Are they going to strike us with nukes? They had just done a test in September, and what's going to happen with this? Well, I kind of want to connect some dots here between these Chinese tariffs and North Korea to have you consider an alternative option, similar to how global growth across the whole world, seeing stocks go up everywhere, probably isn't just due to U.S. tax reform. It's probably a global growth story, something bigger. Maybe something with the Chinese tariffs has to do with something besides just U.S. and China. And so if you look at where does the money flow, right? The world is a flow chart for capital. Who's North Korea's biggest trading partner? By far, it's China. Okay, 85% of the things they buy or bring into the country come from China. 83% of the items they send out go to China. And even the South Korea, when we look at them, huge China trade partner between these two countries. And, is it a coincidence when we look at, well, what are the major things that North Korea exports? So when we look and do some digging and find out why is North Korea an untapped gold mine for tech companies, well, they're sitting on tons and trillions of dollars on what's called trace minerals or rare earth minerals. And they're called rare earth not because they are there's a scarcity of them or a lack of them in our world. It's because there's a lot of them. It's just they are not highly concentrated. So there's a lot of it. It's just not all in one place. Whereas in North Korea, it appears that they have a tremendous amount of rare earth metals, some of them which I can't pronounce their names, but they're used in electronics, and people want those raw materials. The other thing I'll point out is when you look at the things that North Korea exports, by far, some of the biggest things that they export are iron ore. What is steel made out of? Iron ore. So we need to point out that the top 10 steel producing countries in the world, China, United States, South Korea. Well, what's one of the biggest tariff discussions is about steel. High-tech imports or exports by country. China exports a tremendous amount of electronics. They use a tremendous amount of rare earth metals. The United States, South Korea, they all are interlinked with North Korea when it comes to what are the items that come from North Korea. Iron ore for steel, rare earth metals for electronics. These are all interlinked economies where tariffs would impact that relationship. So by taxing steel coming in from China, it would make North Korean iron ore and steel more competitive in the marketplace, which would be a benefit to North Korea. So when we walk through the idea of tariffs in the United States, we want to look at the full timeline of events. And if you remember back September 3rd, 2017, there was another nuclear test. North Korea says it's a hydrogen bomb. Quickly after that, the administration orders new sanctions, which includes completely shutting off trade with North Korea. We're not buying their iron ore. We're not buying any of their goods. And then they're increasing pressure through the UN to do the same through other countries. November 1st, another unique event. Trump meets with President Xi to rein in North Korea. That's a big deal. And later in December, the UN Security Council imposes a new sanctions on North Korea. So by the end of 2017, there's new sanctions. Wouldn't you know it, by the end of the Olympics, remember January's Olympics, February 4th, top North Korean official wants to visit South Korea. And then February 10th, Kim Jong-un invites South Korean president to North Korea. That had not happened, in my recollection, even since the 58-year war began.
that was a huge event. Now, the North Korean president did not go to North Korea, and we'll get there in a moment, but in actuality, Kim Jong-un ends up coming down to South Korea. And here we have February 23rd, more sanctions. And then all of a sudden, North Korea on February 25th is open to talks with the United States. March 7th, North Korea wants to talk about giving up nuclear weapons. So here we have tariffs, sanctions, and all of a sudden North Korea is at the table talking. We think these events are significant. Shortly thereafter, Kim Jong-un makes a secret visit to Beijing on a secret train. That was a big deal. March 27th, China, the day after, says he's agreed to denuclearize Korean Peninsula. Whoa, that's a big deal. April 5th, Trump threatens China with a new $100 billion tariff plan. All of a sudden, China reverses course and says, hey, actually, we want more open trade. April 11th, now all of a sudden, U.S. and North Korea are in detailed talks on Trump and Kim meeting. And that's what, according to South Korea. April 16th, both Koreas meet and consider an end to the 68-year war. China, on April 17th, buys the most treasuries it has in half a year. And then we find out April 18th, actually the day I gave the live presentation, that Director Pompeo met directly with Kim Jong-un, which is a big deal. And today is May the 4th. And if you look and dig, you'll find that the relations between the North Koreans and the United States have dramatically increased. They've now released prisoners, U.S. prisoners, U.S. detainees, and that's a big deal. They've agreed to denuclearize. Kim Jong-un actually came across the demilitarized zone and met with the president of South Korea. So these are major, major developments that are taking place between the Koreas, China, and the United States. And maybe we need to be thinking differently, that these are not one-off events, that the U.S. isn't just talking to China about trade over here and then doing a 360 and just talking about North Korea over here. These are joint conversations that are happening, and it's our opinion that the tariffs actually have more to do with the things that are going on with North Korea, because if you follow the money, if you follow the economic incentives, it's to the benefit of North Korea to agree to peace, and for these tariffs to take place, it benefits North Korea, and that's the trade-off, is really about terrific peace. So really, when we talk about that move, then this move in price, what really happened here? I mean, how did so much selling happen? And if it wasn't tariffs, if the tariffs were happening all through here, and the news covering them when price got bad, what actually went on here? Well, when we use our Adaptiv system, we look across all markets. We didn't see other things panicking. We didn't see gold flying up in price. We didn't see the yen getting crazy. We didn't see credit markets, which typically when you see stress in credit markets, so interbank loans or loans that are used among businesses to fund their operations, there was no stress there. We believe that this move, if you want to get fundamental about it, was more structural than it was something to do with tariffs. And when we mean structural, you might remember from my last presentation, we talked about a market bubble and what are some things that could potentially pop it. And we talked about some known knowns. So rather than some known unknowns, we talked about known knowns. So some of those things were this idea of shorting volatility. And it's very hard to work through this trade, but I'll do my best to explain it. There were people and major institutions that were shorting volatility. What that means is, as a market rises in a smooth fashion like this, there are products that also take a wager on, will the volatility of the market increase or decrease? And typically when markets are rising, volatility is decreased. Notice how the price movements here are much smaller than the price movements that took place over here. These are in the 1 to 1.5% range. All of a sudden, these are in the 2.5%, 3% range moves. This is an increase in volatility. And so what happens is you can place a wager or an investment saying volatility is going to continue to decrease and therefore you make money. The opposite is also true. If volatility increases, something like this, all of a sudden the volatility trade explodes and people get caught. It's very much like, I give the example of it was kind of a free lunch for some people during that time, because if you're shorting volatility and it keeps going down, you keep making money. Well, it works until it doesn't. It's kind of like a turkey, right? A turkey eats really, really good until, surprise, it's Thanksgiving Day and you get eaten by something else. That was kind of the volatility trade in a nutshell. A lot of people were making a lot of money, but it was only a matter of time until all of a sudden that volatility trade unwinds. And what happens is, if you're in that trade and all of a sudden it moves against you, right? Very similar. Let's say you get a loan, you have a loan out, and it gets called due. Well, you start selling other things to cover that loan. So when that volatility trade started to unwind and hurt people and hurt that investment process, they would sell other things, so sell stocks to pay for that. So selling stocks only exacerbated the problem, and so we believe this was a structural event. Now, to be determined, we don't make investment decisions based on that. We make investment decisions based purely on price, but that gives you an idea of what we think that was, that it wasn't tariffs, because tariffs had been going on for a while, those discussions, that it had more to do with volatility. So this leads me to the hat I was wearing, where that had a fancy word on it, fiduciary. So what is that? What is a fiduciary? And the reason why I want to talk about this is there seems to be a misconception of what a fiduciary is. When we look at a CNN Money survey, and 20% of people, so 1 in 5, believe that fiduciary and financial advisor are the same thing. 27% don't know what a fiduciary is at all. Only 42% could correctly identify one. That means over half people don't understand what a fiduciary is. And quite simply, it's a fancy word. You don't need to get hung up on it. But a fiduciary has a legal duty to act in your best interest. And the reason why I'm wearing the hat is because Client First is a fiduciary. And what's the difference? What's going on here? Why is this important to point out? Because not every advisor you meet with is a fiduciary. Okay, there are brokers or broker dealers that you meet with, and then there are registered independent advisors like Client First who are a fiduciary, who are a financial advisor, and we operate in much different ways. And the best way I can explain it is, a broker dealer is much more like a Target or a Walmart. Have you ever gone and checked out at Walmart and you grab the family size bag of M&Ms and you shouldn't do it, but you do it, and you get to the checkout line? Have you ever had the clerk say, "Ooh, I don't think you should be buying that"? Okay, that's a broker dealer. Broker dealer is not going to get in your way. You show up at their office and you want to buy an annuity, or you have some investment that you want to buy, they're going to sell it to you. They just have to make sure it's suitable. Well, that's a much, much different than what we do and what we're legally obligated to do, which is to be in your best interest, which is to consult with you. And you show up at our office and ask us to do an annuity. Hold on, we're going to go through a question, we're going to go through a consultation, we're going to figure out what's in your best interest. And sometimes you don't need that bag of M&Ms, and we need to work through that process. So it's a huge distinction. It's as big a distinction as checking out buying products at a department store versus meeting with your doctor and working on your financial health together. That's the difference, and that's why I was wearing the hat, is because I think it's really important to point out the difference between a fiduciary and a broker. And once in a while I have someone refer to me as a broker and my skin crawls, and so that's why I'm doing this. It's really important to point out fiduciary, the obligation to do what's in the best interest of the client, and that's why we have the name Client First. That's why we have taxes, because we don't understand how someone could have a financial plan that's in someone's best interest without understanding their tax picture, right? Taxes are one of the biggest expenses you can have. By not doing tax planning, we obviously can't see your full financial picture or your financial health, which is in your best interest. It's why we use the Adaptiv system, because it's in your best interest, and we'll get to that in a moment. It's why we offer auto and home insurance. Not because we just thought it was a fun thing to do. It's because when we were working with people and going through their financial health, going through their financial plan, we identified, wow, there are people that have either they don't have enough coverage or they haven't shopped their auto and home insurance for a while and they were paying way too much. And so we could find some cost savings while increasing their coverage at the same time. It's why we have Rob as our attorney alliance, so we can do proper estate planning for clients. That's why we do all these different things, is because they are in the best interest of our clients. And so that brings me to a point that I want to kind of drive home, which is your retirement vehicle adaptive? And your retirement vehicle might be an IRA, it might be a 401k, it might be a brokerage account. When we look at how vehicles perform in different market environments, it's very similar to this US Highway 50, right? We talked about this already. It crosses the Mississippi, it crosses the Great Plains, it crosses the Sierra Nevadas, it crosses the Appalachians. There's quite a diversity of landscape there. And so sometimes we can be driving 70 miles an hour down the road, and maybe this is Montana or something. It's not Montana, but maybe you could drive 80 miles an hour down the road. You got it on cruise control. But there's going to be other times, other market environments, where maybe you shouldn't be going 70 miles an hour. In the world today, the industry today says, nope, you just set cruise control, you hold everything, you should hold every sector, you should hold energy, you should hold, staples, you should hold bonds, you should hold all these different things all at once and not get let go because that's the thing to do. We disagree. There are different market environments that require different type of driving. Maybe using a brakes, maybe even using four-wheel drive. And as an example of this is the daily change of the S&P 500 going back to the beginning of 2017. So a 1% move up is this green, these green bars. A little over 1% move down are these red ones. Cruise control all the way up through January 2018, and then things change, right? All of a sudden the terrain changes. So should we be driving the same way? So how does the Adaptiv system work? How is the Adaptiv system adapting to different markets? How do we do that? So that's what we're going to walk through here. And we're going to use the S&P 500. So again, this is just for illustration. This is for showing you how the system works from a big picture perspective. We do this across all asset classes. Here we're going to use the S&P 500. If you remember, again, it's like that grocery cart. We can see supply and demand happening. This is the dot-com bubble. We can see more supply than demand pushing price down. Then the recovery here into the great financial crisis or the Great Recession. We can see more buying than selling, and it happens over and over. And really, when we look at markets, they are not all the same. I talk about the flaw of averages all the time. You'll read on the news or you'll read in a book, there's an average of a 7.5% return in the market. But it's a little bit of a ridiculous statement because it's dictated by extremes. It'd be like me saying, hey, when you go outside in Wisconsin, it's going to be 48 degrees today because that's the average annual temperature of Wisconsin. But we know that that's dictated by extremes, winter and summer. Same thing with markets. These extremes, 20% of the time there's going to be a 10% loss or greater, or 25% of the time there's going to be a 20% gain or greater. These two extremes are really what drives the average. And so we know that investors would love it if we could just grow assets in a straight line, but we have to deal with some of these market realities. And we know we've talked about some of these market realities in the past. If we look at an account that's a $500,000 account and we look back at the dot-com bubble, these are some market realities, right? A 46% drop from a high to a low in the S&P 500. I mean, that's almost cutting your account in half. And that's kind of a big deal if you're retirement planning, if you're near or in retirement, to have your account cut in half. And remember, the industry says, no, just buy and hold on to this. And that works for certain ages. If you're in your 20s, 30s, 40s, you can be making contributions into this, right? Dollar cost averaging, where we buy, we're making contributions in, and we're buying at low prices. But once you head into retirement, you're no longer contributing, you're no longer accumulating, you're now taking distributions to fund your retirement. And so that's a different deal. And if you're in retirement and your account gets cut in half, guess what? Your retirement gets cut in half. And even if it comes back, it takes an 85% return just to get back to even. And it took you 8 years to get back to even. And then to have to go through it again, this is almost a 57% change. Just to get back to even is 132%. So for 13 years, your account's gone sideways. And as I like to point out to people, sometimes if we're fortunate, we can pick where we want to live when we retire. That's a tremendous blessing if you can do it. But one thing I know you for sure you can't pick is the market you're going to retire in. And so we don't know if we're retiring in a market that's like this or if it's going to be up the whole time. We don't know, but it's important to identify that we need to understand that when you have these losses like this, if you have a 30% loss in your account, it takes 43% to get it back. So we don't wear a parachute to go skydiving. We wear it so we can go skydiving again. Okay, we don't need to protect assets because for the fun of it, we need to protect assets because it has real ramifications in order to earn those funds back, and it affects our retirement. And really, we need to have a way to identify risk. You know, the industry says, hey, just stay the course. Don't worry about any type of market differences. That'll work out in the end. We don't think that's in a retiree's best interest. Now, those market moves and buy and hold and dollar cost averaging will work for 20, 30, 40-year-olds, and that's fine. Where we need to make sure we're understanding the risk as retirees is to buy and hold through 40, 50% market corrections can be very difficult for our portfolio. So how does the Adaptiv system work? It's based on price, trend, and relative strength. We're going to cover price and trend and focusing on the signal and avoiding the noise, how we use this for our clients to avoid those huge drawdowns and implications against our retirement account. So using the S&P 500 as for illustrative purposes, S&P, the price is a fact, right? So this isn't based on news. It's not based on a presidential tweet. It's purely based on price, our system. And really what we're doing is using price to identify trends. When we talk about trends, it's fun to say, but what does it actually mean to identify trends? So this blue line that's on the chart here is actually the prior 40 weeks of information. So all these price moves, right? The blue line gets updated every week as the prior 40 weeks of information. So imagine you go to the grocery store and you check out once each week. You can average the prior 40 weeks of checkouts and get a blue line. And that's what we do with the S&P 500 is we have this way of reducing the noise, right? By eliminating the day-to-day price moves, but looking at the trends, we can see if it's an uptrend or a downtrend. It's very much like removing our nose from the movie screen. It's very hard to watch a TV or a movie with your nose directly on the screen. You got to step back and see what's going on. That's what the blue line allows us to do. Then we combine that information with 10 weeks of information. So the blue line is 40 weeks of information. The orange line is 10 weeks of information. And how we use this is we simply make a rule based on data going way back that if orange is below blue, when this takes place, we're no longer going to participate or be involved because there's too much risk. It's very much like saying, hey, it's below 30 degrees. We've got precipitation, which means snow, and maybe we should just park the car for a little bit and not go anywhere to be safe. When orange crosses below blue, if we look back at research going back all the way to the early 1900s, when this environment, when the market is in an orange below blue environment, selling picks up, volatility picks up, not good things happen in that environment. Now, it doesn't always mean that that's what happens in that environment. You'll notice there's moves like this where nothing happened, okay? That's very much okay because we're just identifying, hey, maybe this isn't the right place to be involved with the market. So when orange crosses below blue, we're not going to be involved. When orange crosses above blue, we'll be involved with that thing. And again, we can use this orange or blue analysis across bonds. We can use it across commodities. And it allows us to participate in markets when it makes sense, right? and avoid markets that don't make sense, right? If we're going to be, there's no reason for us to be in a market where orange is below blue, because that's when bad things happen. I point this out all the time, that it's very hard to unsee this information. Once you see that in an environment when orange is below blue, that's when selling can pick up, and that's when volatility can pick up and can be harmful to your portfolio. It's in the best interest of our clients to pay attention to this information and act on it. And so maybe we need to tap the brakes and drive a little differently through that type of weather. If we color coded it, we can see when it's sunny and when it's cloudy, and when we need to be participating in markets and enjoying the ride, and when we should be probably parking the car. And some storms are worse than others. This type of storm here and here, and sometimes storms are very short-lived, but that's okay. We can then participate in the market again. Because these types of moves where we're cutting our account in half and then waiting to get back to even, very detrimental to your retirement plan. But by eliminating those, this is an illustrative chart of what that looks like to be out of the market and then back in. A $500,000 account in the 2000 .com bubble, like it was here where we started, okay? By avoiding this big drawdown down to 270, when we can protect during that time. And when I say protect, we believe cash is a position too. Not many places believe that. They think you should buy and hold through that. We think we should own cash, and we have, and we do for our clients. We've protected. 2015, 2016 was a good example of that, where we protected accounts. But by doing this, we change this chart. And again, it's not perfect. There's times where it doesn't get out at the exact perfect time. But over time, okay, we're not in this to manage funds on a daily or weekly basis. Over time, on these 3, 5, 10-year periods of time is when we really see a dramatic change. Because look at this, at 2013, okay, your account isn't breaking even, it's up, right? If we look back here, 2013, it's break even. 2013 in this scenario, it's much higher, and we're able to protect assets when it makes sense to do that. So we know investors want a straight line. We know we have to deal with those market realities. So that's why we use the Adaptiv system, not because it's perfect, but because it smooths out that line, that account growth, which is necessary for when you're in retirement. So modern portfolio theory, which says you should own everything, bonds, stocks, maybe even a 60-40 portfolio where 60% stocks, 40% bonds, it's bad for timing. I'll also point out, using that scenario, many people will say 60-40 portfolio, so 60% stocks, 40% bonds. That can be fine for a very long-term period. However, that's predicated on the last 35 years of information. So all we've ever seen for the past 35 years, and remember, when bond prices go up, yields go down, okay? And when yields go up, bond prices go down. So for the past 35 years, rates, these are yields on bonds, have been going down for 35 years. So that's all anybody, maybe almost a generation of people, have only known an environment where bond prices are rising and interest rates are dropping, okay? That looks good in a 60-40 portfolio, because 40% of your account for 30 years has been going up in value. But guess what? That's not how it always is. We think there's some pain coming, because many in the industry will say, if you're near or in retirement, you should hold bonds. We want to caution against that. We will hold bonds, and we do, using orange and blue analysis. But there are periods. So if you look back here, 42 to 68, well, actually 42 all the way to 1982, these are interest rates. So remember, interest rates up, that means bond prices are falling. So if you're holding 40% of your portfolio or more because you're a retiree, and bonds start dropping in price, well, how does that help your portfolio? It doesn't. You can't be holding a portfolio where your bonds are just falling. So we understand that we can use the Adaptiv system to identify when we should be holding bonds and when we shouldn't. And that means it's good for timing, right? We don't have to own all the things. We don't have to own bonds if they're dropping in price. We don't have to own stocks if they're dropping in price. We're we can use the Adaptiv system and avoid bad weather, participate when there's good weather, protect retirement accounts from huge moves. Now, there's going to be 8 to 10% corrections along the way, and that's perfectly normal. It's those 20, 30, 40, 50% moves that can crush a retirement plan, and we need to be aware of that, and we use the Adaptiv system to manage that for our clients. By using the Adaptiv system, we can participate when it makes sense and protect when it makes sense, and that's in the best interest. That's being a fiduciary for our clients using this system to manage funds. This is normally where we took some questions and answers, so if you do have some questions, feel free to reach out. You can call us at 262-335-1700 or shoot me an email. Either way is fine. And then I want to just end with that not all hope was lost when I talk about snow and baseball. The day before my presentation in April, I got the chance to take the team I coach to Miller Park. We actually got to see green grass at the time. I don't think my wife would be too happy if I spray painted the snow with some flowers, but we made the best of it by going and seeing the Brewers play indoors. It was a good time. And in the end, what I wanted to highlight with you guys and have you go home with is the Adaptiv system is an emotional bodyguard for our clients. All markets are uncertain. The only thing certain about markets is the uncertainty, and we use those orange and blue signals to protect our clients from major drawdowns so that their retirement plans aren't impacted negatively and they continue to use those funds for their retirement. It's another reason and another thing included in our overall package, all of our solutions that we provide, whether it's the Adaptiv system for investment management or tax preparation and planning, our financial planning process, insurance, Social Security, even this education, right? This video is not costing you a dime, but we think it's in your best interest to view this type of information and get something out of it. And that's why we do all these different things, because it is in the best interest of our clients. And so we want to highlight that next month, May 16th, there's going to be, it's the third Wednesday, Justin and Renee are going to put on tax strategies, tactics, and new tax law updates. And it's important to know that will be both a midday session and an evening session. Okay, so we're going to have both of them available because it's kind of a big deal with the new tax laws affecting 2018. How does that affect everyone? So we have a noon and a evening one. I believe it's at 6:30. You can call us at 262-335-1700 to reserve your spot. Of course, you can always email us too. You could at my team at Client First Tax and Wealth and reserve your spot. But we hope that you can join us. I hope you enjoyed this presentation. Again, feel free to reach out to me if you have any questions. And just a reminder again that this presentation is for informational and educational purposes only. I appreciate you joining me on this video. Hope to see you again soon.